not the scenario that Theresa May would have hoped for, a hung parliament. On the benchmark of risk, how bad is this for Britain?
So first, it is a Britain issue. It is not a global issue, and markets are reacting very rationally to that. For Britain, it undermines this notion of guaranteeing certainty and stability, that was the Conservative Party phrase, at a time when Britain is redefining its relationship with Europe. So look for a lot of political uncertainty, somewhat less economic uncertainty, and ultimately what happened to markets will be a liquidity issue. But Britain has entered a more uncertain period.
Mohamed, very good morning to you, or good evening where you find yourself. Have we seen market reaction to this yet? What we see now and the way it's muted versus the Brexit vote, is this the reaction we're going to get, or we still need more details? We don't know who's going to lead this country. We don't know who's going to be Prime Minister, whose vision of Brexit.
So what you're seeing is a very rational market reaction, with sterling weaker, some pressure on the currencies, but bonds not doing very much. Why? Because what the election has done is it has widened the range of possible Brexit outcomes. As you said, Anna, we don't know which Conservative Party is going to end up turning up. We don't know what the leadership is going to look like. We don't know lots of things. So what that has done, it has widened the outcomes in terms of Brexit. The currency is responding in a way that's totally rational. And I think the main question is going to be, what does the corporate sector do? Does this delay even further investment plans? And if so, what happens to growth? I think that's the big question from an economic perspective and ultimately from a market perspective.
Well, Mohamed, let's just pick up on that because, of course, the issue is this. We've gone from being one of the fastest growth countries in the G7 to perhaps one of the sicker or weaker projected growth. This has got implications in terms of instability equals lower growth, instability, lower pound, higher inflation. Growth and inflation are going to be incredibly important, given that we have probably an uncertain period ahead of us through to the end of 2017.
That's absolutely right, and you should feel sorry in particular for the Bank of England. This is not an outcome that the Bank of England will welcome, because the last thing the Bank of England wants is stagflationary forces. And this outcome could lead to greater stagflationary forces, lower growth, higher inflation with sterling weakening. So the Bank of England in particular would find itself in a challenging issue. There is a major question mark as to what happens to fiscal policy. You may end up with a slightly less austere fiscal policy because of this outcome. The bottom line is more uncertainty, principally political uncertainty, also some economic uncertainty, and the outcome will be lower growth.
Yeah, Mohamed, from a market perspective, should investors focus on the Brexit plans or the fiscal plans? Which is the fall for you right now?
So I'm going to say something that I don't like saying, but it's a reality. What the markets should be focusing right now is on liquidity. We are in the midst of a massive liquidity trade. Fundamentals don't assert themselves in this sort of environment. So the markets will be driven more by liquidity than by global liquidity than they will by fundamentals. If this were a more rational market where fundamentals were asserting themselves, then this would be a somewhat risk-off outcome. But remember that, as we've seen over and over again, ultimately it is liquidity that prevails, and for good reason. We have two central banks pumping in a lot of money each month, the ECB and the Bank of Japan. We have profits at record levels. Some of that money ends back into the stock market. And with income inequality having gotten worse, the marginal propensity to invest has gone up.
Mohamed, I'm going to turn to just one other global issue, which is probably not going to get a huge amount of coverage in today. But given the testimony of Comey yesterday, do you think that risks are rising in the United States on the prospect of more political risk? And I'm talking about the prospect for impeachment. Just the risks, are they rising in the United States on the back of Comey's testimony?
So what's rising is even more distraction away from pro-growth policies. Remember, the market got very excited initially by the possibility of tax reform, major infrastructure program, and deregulation. What these political distractions do is they delay congressional action, especially on tax reform and infrastructure. And that means that potential growth is lower than it would have been otherwise. So the main victim of all this is the pro-growth policies that the markets need to underpin this liquidity rally.